month. I want to move the conversation over to Larry Swedroe right now. And it's very simple, folks, why I have Larry on. Stock picking has a terrible record, and it's getting even worse. Now, Larry is the chief research officer over at Buckingham Wealth Partners. He's one of the experts in the world on passive versus active management. His new book, The Incredible Shrinking Alpha, basically concludes active isn't working, hasn't been working, and it's getting even worse. Larry, your key finding is that stock picking is bad and it's getting worse. I said it a couple times. Why can't active management outperform? Can you make it just simple for us?
Yeah. First of all, active certainly can outperform. It's that it's highly unlikely to do so, as the research shows. And there are a couple of simple reasons. One, the markets are pretty efficient. They don't make lots of pricing mistakes because 90% of all trading is done by the big institutional investors, people from Goldman Sachs and Morgan Stanley and Renaissance Technologies. They don't make many mistakes in pricing assets. The second thing is there aren't a lot of victims to exploit. If an active manager is going to outperform, they're going to do so by exploiting some dumb retail money. The problem is 70 years ago, 90% of trading was done by individuals holding their stocks in their brokerage accounts. Today, it's more than 90% is institutional on most days. So who are exactly the victims? If Goldman Sachs is buying, then JP Morgan may be on the other side of that trade. And the last is the competition's just getting so much tougher because the people who run money today at these big institutions are all PhDs in the top MBA programs or world-class scientists or mathematicians.
Yeah, it's really quite remarkable, the numbers. You know, S&P does a study on this every year, as you know. The last one they did, 85% of large cap managers underperform their benchmark after 10 years, and 92% underperform after 15 years. That's a pretty poor long-term track records. But everybody always brings up Peter Lynch and Warren Buffett and their ability to outperform. There are a few superstar managers. What was their secret? Or is it now not possible to be a Warren Buffett anymore?
Yeah, they certainly had a secret sauce, and what has happened is the academics have basically reverse engineered it, trying to identify what their common traits or characteristics of stocks that these superstar investors, say from Graham and Doddsville, would buy. And they found out that they bought high quality stocks that also had relatively low PEs, which you can do in a systematic way, which is what many ETFs do, so that it can be replicated. In fact, all the funds my firm invests in the same types of stocks that Buffett bought. Doesn't take anything away from their great success. They figured it out 50 years before the academics, but everyone can access these types of funds or stocks today.
Yeah, you know, Nick, as I said, DataTrek, one of the most data-oriented firms, appropriately, that I know on the street. You've written about this before. Does your research broadly support Larry's conclusions as well, or do you have any points you want to add to this? Where do you stand on all of this?
Well, first of all, Larry's absolutely right as far as the macro comment that it's extremely hard to outperform. I would add two comments to it. The first is, you know, the heyday of active management was in the 1990s. It's important to remember that stocks were compounding at 18% a year from 1980 to 1999. And if you added a little bit of beta to a portfolio, you could get a 23, 24% annualized return, charge 200 basis points, and basically make a good living as an active manager. The returns of the last 20 years for the S&P have compounded at 6%. And it's a whole lot harder to juice up that to 8% and still be able to charge 200 basis points. No one's going to buy that product. So the world has naturally migrated to passive management, and rightly so. And it's been much harder to outperform in such a way that justifies a fee. The second thing I'd say is Reg FD came into effect in August of 2000, and that was the regulation that companies had to give information fairly to everybody at the same time. And that really hurt active management, because prior to that, it was possible to call a company and find out how the quarter was going in the middle of the quarter. You can't do that anymore. So it's been much harder to do a simple arbitrage of information to make an excess return.
I think that's a very good point about Reg FD. It's amazing what a little bit of inside information, that's a legal term, but a little help from the company will do for an analyst and how they're calling the stock at the moment. Dave Naudig, people may wonder, what does this all have to do with ETFs? But it matters a lot for ETFs because actively managed ETFs are now having a moment in the sun, aren't they?
Yeah, I mean, it's been a big year for active ETFs. I think people think all ETFs are indexed. We actually have about 350 ETFs that are actively managed, both bond and stock ETFs and some derivatives-focused ETFs. And it's been a decent year for them. They pulled in about $31 billion into those active strategies, and we've seen a lot of traditional active players coming to the market. T. Rowe Price had a good launch this year. American Century had a good launch. Fidelity. The list goes on of folks who are trying to get into this game. I do not dispute the math at all. Larry's 100% right. It is vanishingly small, the number of folks that will be successful, and whether that's skill or luck, I think, people can debate till they're blue in the face. But the story has been overwhelmingly this shift from active mutual fund assets towards passive indexes, whether they're in an ETF or mutual fund basis. And just to put that in perspective, right now we're looking at about $8 trillion that is indexed in some way here in the U.S. versus about $12 trillion that's in actively managed mutual funds. So it's rapidly becoming parity in terms of what most individual investors are doing in terms of going towards that passive, more predictable source of returns.
Yeah. Larry, let me bring you back in here. It seems like your point about Buffett is that he discovered an investment style, what we call factors today, that worked a long time ago, and he discovered it maybe as earlier than most other people, Graham, Dodd, of course, and Buffett, and that is value sort of combined with quality. We call these factors today, and I think your point is they were brilliant in discovering this, but anybody can replicate that today. It seems like being the first to that strategy is what matters. Is that correct? And are there any other strategies that have been successful that academic research has uncovered besides the value and the quality factor or metric?
This has been the big problem for active management is academic research continues to advance our understanding of how these great managers were delivering alpha. And then it gets converted into beta, Bob. So now we have in the literature over 400 factors that have been identified, which is why my colleague Andy Burkett and I wrote a book, Your Complete Guide to Factor-Based Investing, to help investors manage their way through this factor zoo. And we narrowed that down to just 5 equity factors. So we have not only quality and value, but there is a size premium, a market beta premium, which Dave alluded to earlier. You have a profitability factor and a momentum factor as well. And there's one that almost made our test. We had one little hiccup with it, if you will. That's a low beta premium. Low beta has actually delivered outperformance relative to its risk adjusted, but it only does so when it's in the value regime. So these low beta stocks look like value stocks about 2/3 of the time, but it's become so popular today that they now have become growth stocks, pushing their valuations up, and the history says it doesn't work so well when it's in that regime.
Okay, so the problem I have here is, so you've identified several factors: momentum, quality, what we call associated with generally better earnings overall. What else we got? We've got several other ones. Size, momentum, you mentioned.
Size, profitability.
Here's the problem. Here's the problem I have. Once everybody identifies it, everyone copies it, and so it's not as effective anymore. Isn't that the key point about all this? Everyone copies it, and its value as an outperformer goes down.
Well, 2 things you need to distinguish. One is that if everyone copies it, then the premiums can shrink because money flows into those assets, driving their prices up. You don't change the earnings of the companies, so then the premiums can shrink. But everybody, Bob, knows about market beta being a risk premium. Stocks are riskier. It doesn't mean that the market beta premium goes away, but it can shrink.
Yeah.
It's regime dependent. When you have a non-risk based factor, such as momentum, which is purely behavioral, there it is much more likely the premiums can shrink or even disappear, although what are called limits to arbitrage, which basically reflect the high cost of shorting and the great risks of shorting, can allow even behavioral anomalies to persist.